We're often told that the path to wealth is paved with the highest returns, chasing those moonshot investments. But here's a thought that might flip that on its head a bit. For billionaires, those who've already achieved immense wealth, the real game isn't always about maximizing every single gain. It's often about something else entirely. A different way of thinking about, well, managing their money.
That's a really insightful way to start, and it gets right to the core of the distinction, doesn't it? It's less about constantly trying to hit home runs and more about a much more deliberate and, in some ways almost conservative approach to building and preserving wealth.
Exactly. So in this deep dive, we're going to explore that unique investment mindset, the specific behaviors and decision-making patterns that seem common among billionaires.
Right.
And crucially, our aim isn't just to observe from a distance. Our mission is to extract the key actionable elements that ambitious professionals and entrepreneurs, it's you, the listener, can actually apply to grow your own wealth.
And to get a really comprehensive picture, we've looked at quite a range of sources. This includes academic research into the investment beliefs and habits of the wealthy, various articles detailing specific strategies they tend to favor, and even direct insights gleaned from interviews and, writings by billionaire investors themselves.
Okay, let's get into it then. One of the most noticeable differences, I think, is their long-term perspective. It's almost as if many of us are sprinting towards a financial goal, always looking for the quick win.
Yeah.
Whereas billionaires are playing a much longer game, like a marathon that spans decades.
That's a great way to put it. Our sources, including those insights from Fiduciary Trust on strategic asset allocation, really underscore this extended time horizon. Billionaires frequently structure their investments around these very long-term allocations.
Right.
They're essentially tuning out the short-term market noise and focusing on the substantial power of compounding returns over many, many years. They're thinking in terms of decades, not quarters.
And strategic asset allocation, just to clarify for listeners, that's essentially creating a long-term plan for how your investments are divided across different asset types like stocks, bonds, real estate, based on your goals, time frame, and how comfortable you are with risk.
Exactly. It's that foundational blueprint.
Which is so different from how many of us behave, isn't it?
Yeah.
We're constantly checking our balances, reacting to every little up and down in the market. I remember reading somewhere how the average investor in, say, equity mutual funds tends to significantly underperform the overall market.
Oh, absolutely.
And a big part of that is apparently down to frequent trading and trying to time the market. Our holding periods just tend to be much shorter.
Precisely. And this inclination to try and predict short-term market movements, to buy low and sell high in the immediate future, it often proves counterproductive. As another source we looked at, Plenty, points out, patience is just such a critical attribute for successful investors, particularly those who follow, say, a value investing approach, buying assets they believe are undervalued, which might take a considerable amount of time for their true value to be recognized by the market.
Yeah, it brings to mind that famous saying, in the short run, the market is a voting machine, but in the long run, it is a weighing machine.
That's it.
Over the extended period, the fundamental value, the weight of an investment, will ultimately prevail. And billionaires seem to have a deep understanding and perhaps trust in this principle.
Absolutely. And this long-term view, it naturally influences how they approach risk. Now, you might assume that becoming a billionaire involves taking huge, reckless gambles.
Right. That's the common perception.
But our sources actually suggest the opposite. Their primary concern isn't necessarily about chasing the absolute highest returns available, but about something more fundamental, safeguarding the wealth they've already accumulated.
Yes, that YouTube transcript with the billionaire investor was really illuminating on this. He mentioned that their investment committees are normally only focused on downside protection. Upside will always take care of itself.
Wow, yeah.
Their key questions are around what are the risks? How bad could it get? And how do we deal with it if that happens?
Yeah.
That's a completely different starting point than what many of us prioritize.
It truly is. And the article from Plenty reinforces this, noting that successful investors proactively plan for various scenarios. The optimistic blue sky outlook, the most likely realistic outcome, and crucially, the worst case scenario.
Okay.
This proactive planning allows them to anticipate potential challenges and have strategies in place to navigate them effectively, minimizing nasty surprises.
It's about having a really intimate understanding of risk, isn't it?
Yeah.
Like Warren Buffett famously said, and is mentioned in one of our sources, risk comes from not knowing what you're doing. Their extensive research and due diligence Buffett reportedly spent a huge chunk of his day just reading, for instance. That's how they actively work to mitigate those unknown risks.
Precisely. It's not about being unwilling to take any risk, but rather about thoroughly understanding the risks involved through comprehensive preparation. This allows them to take calculated risks with a greater degree of confidence and, importantly, a well-thought-out plan B or C.
Now, this next point is where their approach might seem a bit unexpected to some. We often think of debt as something to avoid whenever possible, right?
It's definitely common advice.
But it appears that billionaires often view it differently, almost as a strategic tool. They seem to embrace leverage, but in a smart and calculated way.
Yes, this can definitely be a counterintuitive idea. As that article, Adopting a Billionaire Mindset with Borrowing, highlights, ultra-wealthy individuals frequently borrow against their assets.
Okay.
Now, this isn't typically to fund everyday expenses, but rather to finance further investments. They essentially manage their personal finances much like a business would manage its balance sheet.
Interesting. So it's not like racking up credit card debt for luxuries.
No, far from it. It's about a calculated deployment of capital, often secured against assets that are expected to appreciate, to potentially amplify returns without significantly increasing their personal risk profile beyond a certain well-understood threshold.
So they're using their existing wealth as collateral, essentially, to strategically borrow and then invest that money, aiming to generate even more wealth.
Precisely. If they can secure borrowing at, say, 3% interest and then reinvest that capital into assets, they reasonably expect to yield 6% or 7%. That difference contributes directly to the growth of their net worth.
Right.
Furthermore, as another source pointed out, this strategy can sometimes offer tax advantages, potentially reducing the overall tax burden on investment income, though that's complex and depends heavily on jurisdiction and specifics.
It's almost like they're operating with a different set of financial principles, or at least a more sophisticated understanding of the existing ones, which brings up a really important aspect: financial education. It seems to be a cornerstone of this level of wealth building.
Absolutely crucial. I remember a YouTube transcript, I think it was Forbes, quoted someone saying that financial education isn't limited to any specific group. It's essential for everyone, regardless of their current wealth or even their formal educational background.
Yeah.
It's actually quite surprising, apparently, how many individuals in high-level executive positions might lack fundamental financial understanding, but are perhaps hesitant to acknowledge it.
And that point from the 7 do's and don'ts for becoming a billionaire article, the don't. Think you know it all. That really hits home here, doesn't it?
Oh, yeah.
The moment you become complacent and stop learning, you inherently limit your potential for growth, especially when it comes to identifying new and evolving opportunities in the financial landscape.
That's exactly right. Curiosity and maintaining an open mind are absolutely essential. And as that FPA study on wealthy investors indicated, there's a demonstrably higher level of interest in actively building financial skills among wealthier individuals. They recognize that continuous learning isn't just a phase, it's an ongoing and vital process.
Okay, now let's shift gears slightly to the role of emotions in investing. We all know how our feelings, fear, greed, excitement, can sometimes lead us to make less than ideal financial decisions.
Oh, yeah.
But it sounds like billionaires, or at least successful long-term investors, have developed a much stronger ability to manage their emotional responses, especially in the face of market fluctuations.
That's a significant differentiator for sure. As highlighted in, I think it was the CMC Invest article on the psychology of great investors, they possess this remarkable capacity to remain composed and, crucially, rational during periods of market volatility. They actively resist those impulsive actions driven by fear and greed emotions that often lead the average investor to make really detrimental choices, like selling low or buying high.
We've all felt that gut reaction, haven't we? That urge to just sell everything when the market takes a nosedive, or the FOMO, the fear of missing out that pushes us into hyped-up investments without enough thought.
Definitely.
Our sources touched on so many of these common emotional biases. The fear of loss, the allure of quick gains, which is basically greed, overconfidence in our own abilities.
Yeah. Loss aversion.
Loss aversion, right? Where the pain of a loss feels so much worse than the pleasure of an equivalent gain, anchoring to past prices, and even that sunk cost trap where you hold on to a losing investment just because you've already put money into it.
Exactly. And the FPA study offered a really interesting insight here. Wealthy individuals who work with financial advisors are significantly more likely to report that their advisor plays a crucial role in keeping my emotions in check.
Ah, interesting. So the advisor acts as a sort of emotional circuit breaker.
In a way, yes. It really underscores the value of having an objective perspective, someone who isn't caught up in the same immediate emotional reaction to help navigate those inevitable psychological pitfalls that investing can bring.
So it's not about being emotionless robots, but rather about developing strategies and maybe having support systems like an advisor to help maintain rational decision-making.
Precisely.
That naturally leads us to how they actually allocate their capital, their strategic asset allocation, and the level of diversification they employ. It sounds like it often extends beyond the typical mix of just stocks and bonds.
It frequently does. That FPA study we mentioned pointed out that wealthier individuals show a greater tendency to own things like separately managed accounts and explore alternative investments.
Okay, so what falls under alternatives?
Well, alternative investments can include things like private equity, venture capital, hedge funds, certain types of real estate, commodities, basically assets that often have different risk and return profiles than publicly traded stocks and bonds.
Right.
And they can offer further diversification benefits. Separately managed accounts, or SMAs, offer a more customized investment portfolio compared to, say, a standard mutual fund.
So while broad diversification through index funds is still a cornerstone, even Warren Buffett often recommends index funds for most people.
Absolutely. For the average investor, it's great advice.
Billionaires typically have the access and maybe the sophistication to understand and utilize a wider range of asset classes to potentially enhance returns or manage risk differently.
Exactly. And it's also fascinating to observe how wealth creation itself seems to be evolving. An article from Value the Markets highlighted something interesting. While tech and finance are still huge, manufacturing has actually, somewhat surprisingly, taken the lead recently in producing new billionaires, particularly in regions like China.
Really? Manufacturing?
Yeah, specifically pointing towards opportunities in areas like advanced manufacturing, automation, and related infrastructure. It suggests a broadening of where massive wealth is being generated beyond just the digital and financial sectors.
That's a really interesting shift in the landscape. So this strategic allocation isn't a static thing. It has to adapt to reflect broader economic trends and emerging opportunities.
Definitely. It requires that continuous learning we talked about.
Now, there's one final but absolutely crucial element we need to discuss: the importance of taking decisive action, having all the knowledge, the best strategy. It means nothing without execution.
That's absolutely right. The essential traits of successful investors piece really emphasize decisiveness as a vital characteristic. Knowledge without the willingness to act upon it ultimately yields, well, zero returns.
Makes sense.
The article cited examples like Jeff Bezos' long-term strategy of aggressively reinvesting Amazon's profits back into the business for future growth, even when it suppressed short-term profits. Or the Winklevoss twins' early and decisive investment in Bitcoin, despite the uncertainty at the time.
Right. It's about having the conviction born from your research and understanding, and then being able to actually make the move rather than getting stuck in analysis paralysis and never pulling the trigger.
Exactly. It's bridging that gap between thought and action.
Okay, so pulling all of these threads together, how can ambitious professionals and entrepreneurs who are listening to us today actually begin to incorporate these billionaire strategies into their own financial lives, even if they aren't, quite at that level of wealth yet?
Well, I think it starts with cultivating that long-term vision we discussed first. Really begin to think in terms of decades, not just quarters or years. Align your investment decisions with those significant long-term goals you have, like retirement, or maybe funding a child's education, or achieving financial independence.
And hand in hand with that is prioritizing risk management. Develop a deep understanding of the potential downsides associated with every investment you consider. Don't be solely focused on the potential for high returns without a clear and realistic assessment of the risks involved.
Right. Maybe even actively thinking through those best case, worst case, and most likely scenarios for your key investments. It forces you to confront the possibilities.
Good point. Then, once you've established a solid financial foundation, emergency funds sorted, high-interest debt tackled, start to explore the concept of using debt strategically. Understand how leverage could potentially be employed to accelerate your growth.
But carefully.
But yes, absolutely approach this with caution. It's definitely an area where seeking professional financial advice is highly recommended to ensure you navigate it safely and effectively. Don't just jump into borrowing to invest without fully understanding the implications.
Couldn't agree more. And never stop investing in your financial education. Seek out reliable, trustworthy sources of information, books, reputable websites, maybe even courses. Remain curious about the world of finance and investing, and stay open to new ideas and evolving perspectives. The landscape is always changing.
And work on developing that emotional discipline. Become more aware of your own emotional biases. We all have them. And actively develop strategies to mitigate their impact on your investment decisions. As we discussed, seeking objective advice from a trusted financial professional can be incredibly valuable in helping manage these emotional responses.
Definitely. Then diversify your investments strategically. Even if you're starting primarily with broad market index funds, understand the fundamental benefits of diversification across different asset classes. As your wealth gradually grows over time, you can explore other asset classes that might align with your long-term financial goals and your individual risk tolerance.
And finally, learn to act decisively. Once you've conducted thorough research, developed a solid understanding of an investment opportunity, and feel confident in your assessment. Don't let fear or excessive hesitation that analysis paralysis prevent you from acting on those well-considered decisions.
Yeah, that inaction can be just as costly as a bad decision sometimes. So, to sort of recap our deep dive into the investor behavior that really seems to separate billionaires from the rest, we've highlighted this strong emphasis on a long-term focus and unwavering patience.
Right.
A significant priority placed on protecting their capital through rigorous risk management. The strategic and informed use of leverage, not reckless borrowing. A continuous commitment to financial education and lifelong learning. The crucial ability to maintain emotional control in their decision-making. The implementation of diversified investment strategies, often extending beyond traditional assets. And ultimately, the decisiveness to act on well-researched opportunities.
And the real takeaway for you, our listener, is that by understanding these core principles and, importantly, gradually integrating them into your own financial life, you can truly begin to shift your wealth-building trajectory. It's about moving beyond maybe a focus on short-term speculation towards a more sustainable, more resilient path of long-term financial growth.
Which brings us to a final thought for you to ponder, really. Considering everything we've discussed today, which specific billionaire behavior resonates most with you? Which one could you realistically start implementing, even in a small way, in your financial life starting today? What is one small but significant change, maybe in your mindset or your approach, that could potentially lead to a substantial long-term impact on your overall wealth? It's definitely worth taking a moment to reflect on that question.